What's going on, my friends and my financial friends? It's your friend Jack here, and today we're going to be taking a look at a high-paying, monthly-paying dividend stock that I really think could be a long-term hold for a lot of people's portfolios. So with that being said, let's go ahead and let's dive right into the stock. But just before we hop right into the stock, I want to advise you guys, my advice is not financial advice, it is entertainment purposes only, and always do your own research before purchasing stocks and making investments, especially in the stock market. But with that being said, let's go take a look at the SmartCentres Real Estate Trust. So yeah, as I just mentioned, we're going to be looking at SmartCentres Real Estate Investment Trust. This is a REIT. Canada doesn't have that many REITs, but you've probably seen this stock or this logo. There's a little penguin with the SmartCentres text beside it. You've probably seen that at a little bit of complexes around Canada. If you have, this is the REIT that is basically responsible for that. Their market cap right now is 4 billion Canadian dollars, which is quite a bit of money. And they do own a lot of Walmart real estate and Canadian Tire real estate. Their main, holdings are in Walmart, and that's their main tenants for the real estate. And that's a really good sign that they're going to be in business for quite a while, because if you follow Walmart, Walmart, they innovate, they do things. They're not planning on going too far, from where they are right now. Obviously things can happen over the years, but I do think this is a really good, place to look if you're looking to diversify your portfolio into the real estate side of things. Specifically, this REIT, this real estate investment trust, is based upon, retail, the retail side of things. So certain REITs are going to be more diversified in retail and office space and healthcare facilities, wherever else. Maybe it's private owned properties. This real estate investment trust, this REIT, SmartCentres, is focused heavily, I believe over 90% of their portfolio, on retail spaces. So spaces like Walmart and Canadian Tire and those complexes you see around with all the different types of buildings and shopping centers in them. SmartCentres is interested in those type of properties. So if you're investing in SmartCentres, you are investing in retail, right? So you need to be careful that you do want to invest in this, but we're going to take a look at the past 1 year. It has been recovering from that March hit pretty well. It's been going up, and over the past 5 years, you're going to see it still hasn't fully got back to where it was before the March hit. It hasn't fully got back up there. It's trading at 27.77. It left off before the March hit at 29, 28, 31. It left around $30, $30. No, maybe not $30. I don't know if you guys have bucks where you are, but yeah, it left off about $29, $30, and it's still making its way back up. It's looking pretty promising. Make your decision with your own research. Advice again. And let's go take a look at the dividend yield, right? 6.66%, which is crazy. I believe, and I'll put up here in a sec, if I can go to the Yahoo Finance page, they are paying per share, I believe, $1.80, I believe it was. So $15 every month per share, which is quite substantial. If we grab this number and we open a new tab and we times this by 12, we're going to get the amount we get, $1.85 per year, which is quite impressive. And half my screen was probably cut off in that process, but $1.85 per year is something, that's something not to kid about per share. And the shares are only $27. So this is a really high dividend yield paying stock. So REIT, it's a real estate investment trust. You are investing in the retail side of real estate, and it does pay 6.6 dividends. So I've pulled up a chart here of their dividends, and the last time they actually cut their dividends was back in 2005. And since then, they have not cut their dividends. They've been upping their dividends quite consecutively, year after year. And we're going to go ahead to previous page. You're going to see we're in 2006 here. They upped their dividend in 2005. They upped their dividend in 2006. They upped their dividend in 2007. 2008, I don't think they upped their dividends. 2009, they did not up their dividends, but they did not change them. 2010, 11, they didn't really up their dividends. But they haven't changed them. Then over here in 2014, they upped their dividends. 2015, they upped their dividends. Keeping on track, 2016, they upped their dividends. So they've been upping their dividends quite consecutively. 2017, 2018, they've been upping their dividends for the past, I believe, 5+ years. So they are in the dividend aristocrats. They're doing quite well. They have not yet updated their dividends, or the change is unconfirmed, as you can see here, this year in 2021, but I believe they probably will, keeping up with their streak, and more chances to get investors onto that high dividend yield appear of 6%, which is quite hefty. And I'm really liking that. Honestly, right here it says 6.65, but 6.66, a healthy dividend of $1.80 per share every year, which is quite nice. And you're going to be seeing those monthly payments rather than every 3 months or every 6 months. You're going to be seeing monthly payments with this stock, which is also really nice.